Hello and welcome to our video on liquidity ratios. In accounting, liquidity refers to how quickly a business can turn its assets into cash. So understanding how quickly your business can turn its assets into cash is really important in making sure that you can pay off all your short-term debts as they fall due. If you're unable to pay back your current liabilities or your long-term liabilities, that means your business is going to be insolvent and you'll be placed into administration and unable to continue. If you're a director of a business that's insolvent, you must wind it up and place it in administration or you'll be liable. Therefore, managers really care about liquidity ratios, as do creditors and investors. We want to make sure our business is able to continue on into the future. So failing to meet our short-term repayments as they fall due is a guaranteed cause of failure for the business. So analyzing our liquidity ratio should help us get an idea of which businesses are likely to fail and which ones should be able to continue paying their bills in the short term. The first liquidity ratio we're going to look at is the current ratio. The current ratio is the current assets divided by the current liabilities. It's the most frequently used liquidity ratio, and at a very simple level, it's just letting us know if our current asset value is higher than our current liability value, then we shouldn't have too many problems paying off our current liabilities. A higher current ratio indicates greater liquidity and greater safety. However, as with all things, too high isn't always a great thing. For example, Apple have over $100 billion in cash sitting around. Some investors don't like that because they see all this cash sitting in bank accounts not generating higher returns. They think Apple should be investing that money into more productive assets. So although Apple are very safe and have a high current ratio, the downside of that is maybe they're too safe and it's lowering their overall returns. However, that's a very rare situation where a company is worried about having too much cash. Most businesses are worried if their current ratio is getting to below 1. Because the current ratio includes current assets like inventory and prepayments, sometimes if our products are not very popular, we won't be selling our inventory very quickly and we won't be able to turn it into cash. So the quick ratio, also called the acid test ratio, looks at current assets, excluding things like inventory or prepaid assets, to think about if we can still pay off our current liabilities with our cash and our accounts receivable as usually the big current assets. So the quick ratio is calculated as cash plus short-term investments plus accounts receivable divided by current liabilities. And you'll see it, the quick ratio displayed in slightly different ways in different places. Essentially, we're trying to think about what current assets do we have that are likely to be turned into cash within the year. Sometimes our inventory won't sell. Our prepayments we won't be able to turn back into cash. So what liquid current assets do we have? Will they be enough to pay back the current liabilities? And again, if it's more than one, we're usually pretty safe. If it's less than one, we might have to start thinking about selling off some of our other assets to generate the cash or go and borrow money to pay off our short-term liabilities. It starts to get a little bit trickier in those situations. Another liquidity ratio is the operating cash flow ratio. And in this ratio, we take the cash flow from operations from our cash flow statement and we divide through by our current liabilities. We just want to see if our operating cash flows will be enough to pay off our current liabilities on their own. So that's even if we don't turn our current assets into cash. Do we have enough cash flow to pay off our current liabilities in the short term? Again, if we see numbers higher than 1, it indicates more safety. Less than 1 starts to indicate we might see some problems paying back our current liabilities. So in conclusion, liquidity is very important. We want to make sure our business can pay their bills when they fall due, and we want to make sure they're operating with some sort of safety net in place. However, for businesses that are too conservative and too safe and have too much cash, it may result in lower returns. So risk and return are always linked together. We always have to take that into account when we're analyzing our profitability ratios and also our liquidity ratios here.